That 90-day pause that President Trump announced today, again, does not include China. In fact, the president raised tariffs on Chinese goods coming into the U.S. again. Joining us to break this all down is Bankrate Senior Economic Analyst Mark Hamrick. Mark, thank you so much for joining us. A lot to unpack here, so let's get right to it. First, explain to our viewers what happened today with the tariffs. There's a lot of moving parts here.
The president backed down from a big part of what he announced a week ago. And so there was in process sort of a burgeoning financial crisis waiting to happen when we saw the spike in the bond market with the yield of the 10-year Treasury. We were beginning to see some signs of things that were reminiscent of the worst of the financial downturn during the pandemic and even back during the great financial crisis. And so we'll learn in coming days as to what turned the tide on the decision making. Let's remember that there's still a boatload of tariffs, so to speak, that are still going to be in place. As you mentioned, there's greater tariffs being placed on China. We still have the auto tariffs, the tariffs that are planned on auto parts. The president saying that pharmaceutical or drug tariffs might be the next shoe to drop. And it's been estimated, I'm hearing today, that perhaps there's still $300 billion worth of tax increases in the form of taxes on imports that are set to take effect. So we're still in a trade war situation. It is, however, that the nuclear option, in a sense, has been dropped.
And let's talk more about that. With President Trump doubling down on China with a massive tariff increase, can consumers here in Houston still expect prices to go up?
Yeah, we're talking about we backed down to a baseline 10% tax increase, right? And, if you had an elected official telling you, hey, get ready for a 10% sales tax, you wouldn't be taking to that lightly. Now, perhaps some of that can be avoided as well. And in the case of the China tariff, we're talking about 125%. And we're still doing immense amounts of trade with China. That's why Apple, for example, took a huge hit in the stock market in recent days, since it is incredibly reliant on China with what it produces. So we're not out of this sort of rising trade tensions mode. We're just down from the worst of it. And there's still risk to the financial outlook. There's still risk to economic growth. There's still a likelihood that inflation will flare up again if what we know as of this minute stays in place.
Yeah, that risk is certainly something consumers are going to be paying a lot of attention to. President Trump claims it was never his intention to keep the tariffs in place long term. So if he's just doing this for trade concessions, could this ultimately be a good thing?
Well, I'm loath to accept the word of any elected official, especially those who seem to change the story day to day. There were mixed messages coming out of the administration, whether you went with the Commerce Secretary camp or the Peter Navarro camp. We know that this is a president who really does fancy himself, the person who is the expert on the art of the deal. Whether this was a bluff, whether it was recognizing that a crisis was unfolding, I think we're only going to learn that in the coming days through reporting.
We saw the markets rally. A lot of folks started checking their 401ks. As always, should our viewers stay the course or do anything drastic with their investments?
Well, first of all, this is a lesson to long-term investors that to sell in the midst of a panic is usually not a good idea, because the trouble is you have to be right twice. You have to be right on the initial decision and timing to sell, and then you have to be right when to get back in. In this case, maybe you would have sold 2 days ago and then get back in early this morning. That's not generally a good idea. For those who are investing, let's say, for retirement, and those who may be looking at retirement in the near term, they should be doing a gut check here and see whether their allocations are where they should be, how much in stocks, how much in bonds, in cash, and the like. For younger investors, those who are saving for the very long term, we're talking about decades before they're going to need their retirement savings. So they are the ones who really can sort of just strap on the seatbelt and know that as of right now, you're still getting in at lower levels. The S&P 500 is still down 7% year to date.
Some great takeaways. Mark Hamrick, Senior Economic Analyst with Bankrate. As always, we appreciate your insight and perspective. Thank you.
Thank you.